Kenya, Egypt, Zimbabwe, Nigeria, Ghana, and Zambia are just a few of the African nations currently lacking in US currency. In international commerce, the dollar is the most common currency to pay for imports, necessities, and industrial inputs. These nations rely on the US dollar. Global trade is conducted in the currencies of the world's major economic powers, principally the US dollar, the European Union's euro, the Japanese yen, and to a lesser extent, the Chinese renminbi and the UK's pound sterling. Individuals, firms, and government elsewhere in the world need these currencies to import goods and services and make other payments overseas. Now, a dollar shortage is simply a situation where the demand for this foreign currency exceeds the available supply at the current exchange rate. And depending on how the exchange rate is determined, a dollar shortage will present itself in different ways. In countries operating a fixed exchange rate regime where the national currency is pegged to a hard currency, the shortage may be physical. The banks that normally supply their customers with dollars may simply have none to sell or are forced to ration their limited stock. So is dollar shortage something that can be dealt with? This morning, I'm being joined by Dr. Chris Ede, who is the CEO, Center for Export Development. And it is nice to have you, Doctor, join us on this conversation, and happy Easter to you.
Good morning, Lekon, and good morning, viewers.
Now, to put this conversation in proper perspective, I'd like you to educate the audience on what a balance of payment means and how it affects a nation's commercial ability.
Thank you. The balance of payment tracks the international transactions. When funds go into a country, a credit is added to the balance of payment. When funds leave a country, a deduction is made. For example, if a country exports 100 tons of ginger to another country, a credit is made in the balance of payments. There are two categories of balance of payments. There's a current account and there is the capital and financial account. If a transaction creates liability, like selling bonds to another country, it gets counted in the capital and financial account. But if a transaction does not create liability, the transaction gets counted in the current account. If trade surplus exists, if a country exports more than it imports, and the trade deficit exists if a country exports less than they import. So this is basically what the balance of payment means.
About trade and in terms of trade, we are aware that world price, as we know it, are actually determined and controlled by larger economies or large economies and world powers, as it were. And we have smaller economies who have little or no say in terms of capacity in altering their terms of trade. Now, we have this imbalance, which is something that would always occur within the business mix internationally. But then is there a way that we can reduce or address or minimize this imbalance?
The statement is very true. Larger economies such as the United States, China, and the European Union have a significant impact on the global commodity prices, including oil, minerals, and agricultural products. Developing countries that rely on the export of this commodity often find themselves at the mercy of the larger economies. One potential remedy to this imbalance is for developing countries to diversify their economies and reduce their reliance on the number of exports. By developing other sectors such as manufacturing and service, these countries can create new sources of growth and revenue that are less dependent on the global commodity prices. This can also help their vulnerability to external shocks and give them more leverage on negotiating better terms of trade. Another potential remedy for developing countries is to work together to increase their bargaining power in the global market by forming regional trade blocs and other forms of economic cooperation. This country can also pool their resources and work together to negotiate better trade terms with the larger economy. This will help to level the playing field and give developing countries more control over their economic destiny. Finally, some experts have called for the rethinking of the global economic system to make it more inclusive and equitable. This could include the reforms to the global trade rules and institutions to ensure that developing countries are not unfairly disadvantaged, as well as greater investments in infrastructure and human capital to help this country build their own capacity and compete more effectively in the global market. But overall, while there is no single remedy to this imbalance between the small and larger economy in the global trade, a combination of strategies that prioritize diversification, cooperation, and system reforms can help address this long-standing challenge.
Let's look at the capacities of these African countries. We see that due to global shocks and different economic challenges that radiate within the international global system, we see that exports and trade, as it were, with other African countries seems to be impacted negatively, and the numbers are dwindling and it's becoming worse in terms of trade for these African countries. So in your summation, are you saying that if African countries can actually increase the volume of imports, then they can have a fair share of the global wealth in terms of revenues that could accrue to them?
Yes, Lekon, an increase in the export volume alone is not likely to reverse fully the negative impact, but an increase in the export volume will help generate more revenue and improve the balance of payment. It does not necessarily address the underlying factors that are driving the disruption and worsening the terms of trade. One of the main drivers of this disrupted exports and worsening terms of trade in many African countries is the volatility of the global commodity prices. These prices are often influenced by factors beyond the control of individual countries, such as the global supply and demand trends, the geopolitical tensions, and the macro economic policies in larger countries. This means that even if African countries are to increase their export volumes, they still may be subject to fluctuation in the prices that undermine their economic stability. Another factor contributing to the challenges many African countries is the lack of diversification of their economy. Many African countries are heavily reliant on a few key exports, such as oil, minerals, and agricultural products. This makes them vulnerable to external shocks, such as a decline in global demand and disruption in supply chain. To address this vulnerability, African countries need to prioritize efforts to diversify their economy. Developing other sectors such as manufacturing and service are less dependent on the global commodity prices. And in addition, these structural factors, many African countries are facing non-economic challenge such as political instability, corruption, weak institutions. These factors can create barriers to trade and investment, as well as undermine the business environment and erode the investors' confidence. In conclusion, while an increase in the export volume can certainly help generate more revenue for African countries, it's not a panacea for the complex challenge they face. Addressing the root cause of the disrupt export and worsening terms of trade requires a combination of strategy that prioritize diversification, stability, and the institutional reforms in Africa.
Let's look at the role that the dollar and, of course, local currencies are playing in terms of trade volumes and, of course, trade transactions between Africa and the rest of the world. Last week, we had a fundamentalist economist, that is Dr. Betin Kuvi, and he made mention of the fact that Africa should stop using the dollar for transaction, because he said that the use of the dollar for transaction is actually killing African economy. So I'd like to ask, is it possible for African countries to actually jettison the use of the most powerful currency in the world for its transactions? Can Africa do that?
Having swap deals with countries like South Africa can potentially reduce the dependence of African country on the dollar. I think Africa can actually, do transactions better and get more value for their commodities if they can reduce the transactions in dollars. Swap agreements will allow countries to trade with each other using local currency rather than the dollar, which will help reduce the transaction cost. The swap deal, for example, between Nigeria and China, for instance, allowed countries to trade in their local currencies, thereby reducing the demand for US dollars in the two countries. This not only helps reduce the foreign exchange risk, but also promotes trade and investment between the two countries. However, it is important to note that such swap deals may not be the total solution for the economic challenges faced by African countries. There are many structural issues, such as low productivity, poor infrastructure, and weak institutions that needs to be addressed to achieve sustainable economic growth and development. Additionally, I see swap deals, reducing the dependence of Africa on the dollar, and will actually help African countries get better value for their commodity. Nigeria and China had a currency swap deal some years ago. If this is fully implemented, the outcome will be for Nigerian currencies and the Chinese yen to reduce the dependence and the scarcity of the dollar in the continent, as the two countries are one of the biggest generate one of the biggest demand for dollar in the continent. Under the deal, the Nigerian Central Bank will be able to swap naira for the yen, and the People's Bank of China will be able to swap yen for naira, but to a limit of about 15 billion Chinese yen. If the currency swaps are fully implemented, it will have several potential outcome for Nigeria and the Chinese yen.
All right.
They increase
Well, let's keep it at that, because I actually want to tie this next question to what you're saying, because you're talking about how African countries can solidify their currency, as it were, and engage the use of swap deal, most especially with Africa and, of course, with China, to strengthen the value of the currency and the value of trade investments between them. But then I want to tie it to the BRICS, which is said to be a rising macroeconomic trading and manufacturing bloc. Now, we have heard of stories that the BRICS is hoping to have a single currency, as it were, and is hoping to build some sort of trade volume and value chain within these countries. We're talking about Brazil, Russia, India, China, and South Africa. But then, if they're able to succeed with this and strengthen the economic ties that they have, do you think that they are well positioned to wrest power from the dominant US dollar, as powerful as it is on the international markets?
Yes, competition is always good. As we've seen in the recent weeks, that more players are interested to join forces with the BRICS. Countries like Saudi Arabia expressing interest to become part of the bloc will actually reduce the dependence on the dollar. Having the BRICS has seen a rise in macro economic trading due to the large population of the players and the abundant natural resources and the rapid growing economy of the member country. However, while they have collectively increased their influence in the global economy, it may not be enough to completely shift the power away from the dollar. The US dollar is currently the world's dominant reserve currency, which means it is held in a significant quantity by governments and institutions around the world for international trade and investment. This status gives the US dollar a significant advantage in the global economy, which includes around the world. But if we have an alternative trade currency, it will reduce borrowing cost and also increase the purchasing power of local currencies. Therefore, it's unlikely that the BRICS nation will be able to completely shed power from the dollar on the international market anytime soon. But their growing influence will continue to chip away the dollar dominance and open more rooms for competition especially in the alternative markets and developing countries like Africa.
About value of currencies and how much strength it can garner, most especially African currencies, as it were. We understand that there's been a bit of lacking in terms of the value chain along the business lines and what Africa is able to produce and export. But then I'd like to find out, if Africa is able to improve the value chain along its business lines, do you think that can improve Africa's revenue and of course improve the value of its currencies, or of course Africa's currencies too?
Yes. Improving the value chain in Africa will potentially boost the continent's earning power and the value of its currency. Adding value to raw material and commodities through manufacturing and processing will increase their worth. Creating more profitable markets for Africans to participate, like what we've seen with the Africa Free Trade Agreement, will lead to increased foreign exchange rate earnings and reduce reliance on import, and also increase job creation. Additionally, as value-added products are typically higher priced, this could increase the demand for African currency, leading to an appreciation in their value. However, for this to be successful, Africa needs to invest in infrastructure, education, technology, to facilitate the production and value addition to these goods. But as the free trade has kicked off, and with the progress we are seeing with the free trade and policies from other countries insisting that their raw materials be processed, in the continent, will in a big way boost the earning, and value for the African currencies.
All right, thank you so much, Dr. Chris. Well, of course, we've had different conversations around investments, most especially for African countries in different critical areas of its economy. But then when it comes to implementation, that has always been a challenge. But then, just as you've said, we're hoping that there could be some sort of isolated and synergized efforts between these African economies, as it were, so that they can drive some sort of positive growth in terms of its economy. Thank you so much, Dr. Chris, for joining this conversation. Appreciate your presence.
Thank you. Thank you.
Now, periodic dollar shortages are part of the issues that Africa is facing, and it's an enduring fact of life for many income countries, even as growth and development mean they are likely to become less frequent and less severe over time. Now, the current pressures experienced by some countries in Africa are certainly severe, but these can be managed if countries maintain high quality macroeconomic management abilities like the BRICS are doing, and increase exports for more foreign exchange earnings. That is where the conversation should be gearing towards as Africa moves on in terms of policy implementations along these areas. We'll go on a very short break, and when we return, we'll bring you international business news. Do stay with us.